The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He is my good buddy, Ronnie Stöferle, and a gold expert, and he comes out with his mega reports. Ronnie, how long are your reports? How many pages?
350 normally.
Is that all?
but you know, my aim and my ambition is not to write the longest gold report, but hopefully one of the best ones. So somebody said quantity is also a quality, but it's not only about the length.
That's right. It is definitely the best gold report in the business. So usually we kind of go back and forth with a interview, and I'm asking questions, but you just came out with a recent report. I think it was called Monetary Tipping Point. Is that correct?
Yeah.
That sounds fascinating. So I think for the viewers, what we'll do is kind of dive into your report and then go just kind of hit the highlights and go back and forth and see what type of value we can deliver for the audience. I think they'll really get a kick out of that.
Absolutely. Let's do that.
We've got Monetary Tipping Point, and we kind of got your partners. And so you start off with a quote. It looks like the point at which a series of small changes or incidents becomes significant enough to cause a larger, more important change. Okay, so this is going to be our theme, I assume.
Exactly, yeah, and it's I came across the term tipping point by reading the book by Malcolm Gladwell, and he says this tipping point is basically that magic moment when an idea or a trend or a social behavior crosses a certain threshold, then tips and it spreads like a wildfire. So I mean, we all know, George, nowadays I'm actually here in working from home, experiencing our fourth lockdown now in Austria.
Oh my
gosh. we all know that one single sick person or a bat or whatever can start an epidemic. But also a precisely targeted push can cause a new fashion trend, and I think those tipping points are not confined to sociology only. We're seeing it in physics, we're seeing it in history. I'm quoting, for example, the assassination of the Austrian Archduke Franz Ferdinand being the tipping point in geopolitics and basically causing the First World War. And I think what's really important and why I use this analogy, I think it's important to say that those tipping points obviously are not the reason for something happening. It is not the assassination of the Austrian Archduke that caused the war, but it was the precarious buildup of arms, of rivalries, of tensions that already lasted for years, if not decades. Right. I don't know if you read the book by the historian Christopher Clark. It was called The Sleepwalker.
No, but it just sounds like it's the final snowflake that causes the avalanche type thing.
Exactly. So why do I come up with this analogy? Because I think that the COVID crisis was basically the tipping point for inflation. So this pendulum that is always swinging between inflation and deflation. We all know that in our, let's say, a true laissez-faire system, a truly capitalistic system, in a sound monetary system, deflation would basically be the normal environment.
Right.
But there's this central bank policy and politics in general pushing against this natural deflation. And I think that COVID is now really, it was the tipping point that led to inflationary forces now being stronger than deflationary forces. So this is basically the main topic of this keynote that I prepared.
Do you see that occurring as far as this tipping point from a standpoint of creating future inflation as a result of the demand side of the equation, or we'll just call it money printing to use that term very, very loosely? or do you see it from the supply side of the equation, when with governments continuing to lock down into the future potentially, creating less economic output and therefore fewer goods and services, while at the same time the government's creating this sustained demand through money printing, and that is what is creating the maybe the secular consumer price inflation? Do you see it from both sides, or how do you kind of see that playing out, Ronnie?
I think it's always a combination of many different factors,
Right,
and
right,
that's what basically makes it so complicated. And for one of the funds that are managing, we created our incrementum inflation indicator that basically is telling us, are markets currently discounting inflation or deflation, and what's the momentum?
yeah,
Because as we know, those funny government statistics basically only tell us what happened in the past. So they tell the story of inflation a couple of months ago, while financial markets are obviously looking through the windshield. Now I think that the price of gold, for example, I once called it the seventh sense of financial markets. I think the price of gold was already discounting future inflation very, very early on.
right,
And I think many other markets, energy markets, commodity markets, but also inflation expectations slightly later, they already discounted that inflation will become a concern. Now, to answer your question, George, I think it's what's really astounding is the fact that we saw extreme growth in broader monetary aggregates
right,
in this crisis, in this recession that we experienced last year. And I think this is already one of the main differences compared to 2008, 2009, where high-powered money, so basically central bank MZM or M0 took off, but broader monetary aggregates basically collapsed. So I don't want to defend central bankers, but I think they were just trying to compensate the enormous slump in broader monetary aggregates by flooding the market with high-powered money. So I think this is a main difference that we're seeing now. M2 actually already in the course of the recession last year was up significantly. And my dear friend Russell Napier, I think he was one of the very few and probably the earliest coming up with one of the explanations for that. He said that basically credit guarantees are one basically new way how money is created. And I think, I worked in a bank for a couple of years. And if the government basically says, well, we guarantee for this loan, of course I'll make the loan if there's no risk associated. So I think there were many fundamental factors coming into play in this crisis. Also the fact that this time around, I think it's really fiscal policy being in the driver's seat.
yeah,
So
right,
my thesis is we should focus less on the Federal Reserve. We should focus more on what politicians are doing. And George, we all know politicians, and I think there chances that they will give up their power that they got over the last couple of months. I think chances are pretty low. So I think fiscal policy is now really taking over. They saw that they can kind of fine tune the economic cycle, that they come up with enormous amounts of money being thrown into the market, and nobody really questioned it, unfortunately. So I think going forward, fiscal policy will be clearly the driver, while monetary policy is becoming a sideshow.
yeah. Let's unpack that just for the viewer really quick. So basically what Ronnie's saying here is in 2008 in the GFC, they started quantitative easing, which increased the size of the Fed's balance sheet. So they were printing quote unquote bank reserves denominated in dollars, but those were just dollars that were liability of the Fed. It didn't necessarily mean that the banks, the commercial banks themselves, created more loans and then more dollars that were circulating in the real economy as measured by M2 money supply. So you've got to differentiate between the dollars that are liabilities of the commercial banking system and dollars that are liability of the Fed. And what Ronnie's saying now in 2020, because the government has come in, and we'll use the U.S. government, deficit spending but to the tune of $5 trillion, since a lot of those bonds are going out of the balance sheet of the Fed, they are increasing the base money, if you will. They are increasing the amount of bank reserves denominated in dollars. But because this is combined with government deficit spending to that degree, it is compensating for even a potential lack of bank lending. And who knows how Russell's theory fits in there. Even if the bank lending has gone down, it would have gone down a heck of a lot lower if they would not have backed up those loans. So they're not having to carry them on the balance sheet. But the bottom line is, because of this deficit spending that we're seeing now, the M2 money supply is increasing, literally going parabolic. Whereas back in the GFC, the only thing that expanded was the balance sheet of the Federal Reserve. So that didn't necessarily filter into an increase of the money supply as measured by M2, or the way I like to look at it, the dollars that are liabilities of the commercial banking system, because those are the dollars that are really out there circulating, chasing goods and services. Do I have that right, Ronnie?
That was a pretty perfect summary. Thanks a lot, George.
Okay, so one other thing I wanted to ask you before we move on, though, Ronnie, is we talked about the tipping point for inflation and the tipping point for World War II. And it seems as though a lot of times that tipping point, or that final snowflake that causes the avalanche, can be psychological. It's not just something that's a quantitative, in the size of M2, that it's like a psychological shift in society. And that's something that I'm seeing right now in the United States that I've never seen. Even during the GFC, or even during these, times in the past decades, I've never seen the media and just normal people talking about price increases and getting very frustrated to the extent that I'm seeing people talk about that today. Do you think that's another tipping point we should really look for?
Yes, and I think it's even more extreme over here in Europe. I think that also to some degree explains central bank policy, because I think that the US and the Federal Reserve is still kind of traumatized by the Great Depression, which led to the deflation. Or I mean, we can talk about that at length, and I think everybody should read Rothbard on that. While over here in Europe, Austria, but especially Germany, is traumatized by hyperinflation. So I think if you talk to people here, for example, about physical gold, people have got a completely different attitude when it comes to physical gold. You can buy it in every bank. You can buy it basically all over on TV. They're making commercials now that you have to buy some gold coins for your kids for Christmas. So I think here where inflation is probably, for historical reasons, much more of a concern and of a topic. I think people are way more sensitive. And I mean, in Germany, we had numbers coming out, going higher and higher. We had the PPIs coming in at I think 16% in the Eurozone, which will translate to the CPI, at least to some degree, while the ECB is still doing basically nothing. So, George, I think last year we had a chat when we published our special study on inflation. It was called "The Boy Who Cried Wolf." Yeah, and we chose the topic because we said, well, many people and many analysts were shouting hyperinflation already after the GFC and then in 2011 and 2013, and nothing happened. But now the third time or the fourth time, we should be warned that inflation is really becoming a concern, but nobody is listening, like in the fable by Aesop. Now, back then when we published the study, CPI in the US was at 1.2%. Now it's at 6.2%. So we saw a dramatic shift, but still central bankers, economists, most of the investors still believe that it's only transitory. Now, George, I don't think that it will go, one straight line up, but I think that going forward, the great moderation that we were basically brought up with, those 4 of almost 5 decades with inflation going lower and lower, I think this is over, and I think that going forward, people will have to prepare for higher inflation scenarios. So 3, 4, 5%, perhaps even higher. But the thing is, I mean, we had such high inflation numbers already quite often in history. But the big problem is, I don't think that the bond market will be able or will be allowed to reflect those inflation numbers.
What are bonds trading in the Eurozone? Are they still negative in Germany?
Yeah, they're still slightly negative, and I think Greek debt is still at a lower yield than US 10 years. So it doesn't make any sense. But of course, I mean that leads us to financial repression. So, for example, we manage a couple of funds, as you know, and we wouldn't be allowed to buy physical gold in most of our funds, while it's perfectly fine to buy 10-year Greek debt, for example. We can even take enormous amounts on leverage on that. So what I mean by that is money is being funneled into directions where it would normally never go to. So we are already in this scenario, but long story short, inflation is a topic again, and I think it will remain a topic.
You know what's interesting, when you were saying that, I'm thinking about a chart of the CPI in the 1940s in the United States, and we had 3 significant price increases there, or spikes, let's say, at the beginning of the 40s, the middle of the 40s, and at the end into the 1950s. And in 47, inflation as measured by the CPI got up to 19%, while they had, I believe, the long bond pegged at 2.5%, something like that.
Yeah.
Now, what's fascinating, obviously, those bondholders were just getting their butts handed to them, and a loss of purchasing power. But what's fascinating is if you actually look at the interest rates toward the end of the 1940s, they actually went under the Fed's target, which would imply that the Fed didn't need to buy the bonds, at least during that time frame, to keep them sub 2.5%, while you saw these significant spikes in inflation. And so it's like the bond market is telling you, what the bond market is telling me, Ronnie, and I think the gold market as well, and I'd love to get your opinion on this, is that we're going to continue to have a lower global economic output as a result of governments continuing these lockdowns. I don't want to use the word indefinitely, but let's just say into the future. And so therefore, the bond market is maybe telling us that, hey guys, we're not at the 1970s yet, but we are at something that looks very similar to the 1940s, where when the government comes out and let's say they can agree for 6 months, and they come out with these $5 and $6 and $7 trillion, which I think we'll see in the future, spending packages that are just pure deficit spending, then you're going to see these big spikes up to 6, 7, 8, 10, 15%, even as measured by CPI. But then when the governments and the politicians cannot agree, then all of a sudden those deflationary pressures kick in again. And then you see inflation go back down to, let's say, 4 or 5%. until the government spends a ton of trillions more, and then it spikes back up to 10 or 12. Something like the 1940s, as opposed to the 1970s, where inflation, you kind of saw higher highs and higher lows all the way up to kind of a crescendo in 79 or 80. What do you think about that?
Well, that's an interesting thought. I mean, I would say that the 1970s inflation was primarily driven by food and energy price inflation, and therefore I think I always have a hard time comparing the current setup to the 1970s because the world changed dramatically, and therefore I think we should also take geopolitics into account, globalization, and so on. I think that, for example, one driver for inflation that is very much underrepresented in a discussion is the renminbi. We shouldn't forget that China and basically China joining the world market, massively devaluing the renminbi. I think in 1994, when they devalued the renminbi by more than 50%, they unleashed the Chinese labor force.
Right.
It was such a big deflationary force unleashed to markets, and now I think this is kind of reversing. I think it's very, very interesting to follow closely the renminbi and the strength of the renminbi, to follow what actually the People's Bank of China is doing. I think Charles Gaff he called the PBOC the basically the new Bundesbank. So I think this is also one important driver in this equation. But as you're coming up with the 1940s, I've got one chart in my slide deck, I think, which is very, very interesting. And if we look at the velocity of money, so I always want to emphasize that inflation is a process. There are always time lags involved, and I know that Austrians are a bit critical when it comes to the velocity of money. They speak about the demand to hold money, which is more correct. But if we have a look at this chart, we can see that in both 1933 and 1946, the velocity of money was at similar levels. Now it's actually even lower, and in both cases, the US government resorted to radical measures. We all know in 34 they devalued the dollar against gold by almost 70%, and 46 till 51 they basically, in cooperation with the Federal Reserve, enforced dramatic financial repression. So I think it wasn't called a yield curve control, but this is what they actually did. So I think that we should not rule out similarly extreme measures going forward. And I think, if we make a comparison, if we compare now with the whole Omicron scare, if we compare that to early 2020 when the whole Corona crisis started, back then the Fed funds rate was at 1.7%. Now it's still at 0%. The Fed's balance sheet was at 4 trillion. Now it's at 8.6 trillion. The Schiller PE was, I think, at 31. Now it's at 40. So I think we should not forget that the traditional toolbox of the Federal Reserve now is basically exhausted. We already saw that. Our friends in Frankfurt, the ECB, in the last cycle, they didn't even hike once. But now I think also the Federal Reserve is in this zero rate trap. So there's not too much they can actually do. I think that a yield curve control will be implemented at some point. I think that they will at some point also start buying equities. But this basically confirms my view that now fiscal policy will take over. And let's face it, I mean, Janet Yellen coming in as the Treasury Secretary, as the former head of the Federal Reserve, I think the symbolic character is quite telling. It's the same with Mario Draghi now being the Prime Minister in Italy. So I think this this much closer relationship between monetary policy and fiscal policy is really something that that was caused by this tipping point of the Corona crisis,
Right.
and therefore I think that basically we should really focus less, and I have to remind myself as well, because all financial market participants, they try to anticipate what the Fed's going to do next, but what if they aren't in the driver's seat anymore? I think that it will be I think that at some point markets will realize, well, we shouldn't care too much about Jay Powell and Lagarde. We should focus more on what the White House is doing.
I completely agree. I say on my videos quite often, I think we've gone from a Fed put to a government put.
Yeah.
And that people, if unfortunately we live in a time where to answer economic questions, you have to start by answering political questions.
Yeah.
And I think that's we definitely see eye to eye there. And if someone wants to figure out, what's going to happen with the stock market or anything, you got to start by saying, okay, what on earth is the Biden administration going to do? Or what is Janet Yellen going to do? Or is Omarova, I don't know if you saw his nominee there for, I think it's comptroller of the currency, but she was someone that was very, very, let's say, pro central bank digital currency. She's someone that's talked about the Fed or the Treasury actually buying and selling the S&P 500 to micromanage the level of the stock market. I mean, she is. I mean, she is a central planner's dream. Like she's, if you went to your computer and tried to create a central planner, out would pop Amarova, So let's go back up and kind of complete the thought here, because I kind of went to the end of or in the middle of your chart deck here with velocity, but let's go back and start with this, the one with Volcker here. That's from the great moderation to the great recklessness. So I'm sure this ties in exactly to what we're saying, but do you want to go over the main takeaways from this chart?
Well, I think, we're all familiar with Paul Volcker, and his job was basically to kill inflation. And now we're seeing this exact reverse Paul Volcker mandate, where central bankers all over the globe told us we have to do more because inflation numbers are too low, because deflation is such a big threat. Now inflation is here. Now they keep telling us it's transitory, although Jay Powell had to throw in the towel recently. But I think, we shouldn't forget that market participants, that politicians, that economists, that basically everybody was getting used to this great moderation environment, and I think it will take a while until we realize that now we're moving into a new regime, and I think I think it's not a conspiracy or anything. I mean, that's exactly what everybody was telling us. We need more inflation. Now it's here. Now we should realize what this means for our portfolios. So that's George, why I always really enjoy talking to other asset managers from Brazil, from Turkey, from high inflation countries, people that focus on inflation and weakness of their currencies when it comes to portfolio construction. That's basically the first thing that they've got in mind, and for them, gold, precious metals in general, commodities are basically a natural choice. While if you talk to a institutional investor nowadays about the virtues of having some gold in your portfolio, you will probably be ridiculed. at some point this is going to come back, but I want to show with this chart that it's going to be a process, and that it's going to be take a while until people really wake up and realize, well, this great moderation is over.
Right, got it. And then we talked about M2 money supply, which is your next chart. And then we've got the money growth significantly higher than in the 70s. So this is measured by year on year M2 money supply. Is that correct, Ronnie?
Exactly. So this number is going to come down. I also think that over the next couple of weeks, this whole inflation mania will calm down a bit. I think that the moves that we saw in markets recently are clearly telling us that, you know, inflation it's not a straight line. Probably it's already quite a I wouldn't say a crowded trade, but something that will kind of level off for the next couple of months.
Yeah, that was my next question, because you and I are contrarians by nature, I think. So how does that make you feel when you actually agree with Jerome Powell?
Yeah, well, so that was.
Does that give you cold sweats that you get nightmares?
I mean, I have to say, I would rather enjoy having a beer with Jay Powell than with Christine Lagarde. I think that actually my buddy Grant Williams said Jay Powell, he's a nice guy, and I think that, you know, he just has the wrong job, but it was his choice. But you know, it was interesting because, you know, exactly before Friday's sell-off, and we all know that this was in very, very thin market trading due to Thanksgiving. Actually, Goldman Sachs raised their rate hike forecast to I think 3 hikes in 2022, and they said that the Fed will double the pace of tapering.
Yeah, that's unbelievable, because it's not just rate hikes there. That's important to point out, that before you get to the rate hikes, they have to take QE from 120 or 105 down to 0.
Exactly.
So how is the market going to absorb that?
That's a big question. But the interesting thing when it comes to this Goldman forecast, they still expect the stock market ripping higher, and I think they see the S&P 500 at more than 5,000 points. I think 5,100 by the end of next year. So it doesn't really fit together, and I think, you know, the big challenge for the Federal Reserve now is, you know, they have this very tight relationship with financial markets, and I think, you know, they really have to fine tune everything that they say, and therefore it was quite astounding that what actually Jay Powell then said was much more hawkish than the prepared speech that he wanted to give, and that was quite astounding to me. But I think, you know, first of all, let's not forget that tapering is only the first step of tightening, right. And for me, there's really no doubt that the Federal Reserve will tighten too much, as they always do, and that the economy and markets will roll over. So Peter Bokwa, he wrote, if Mike Tyson gave me a fair warning that he was going to punch me in the face, no matter how prepared I am, I would still hit the floor. And I think, you know, the Federal Reserve can try to prepare the markets, but still it won't work. And we know that they're way behind the curve, obviously, and therefore, as you rightly say, I think now Powell caving in and saying, well, perhaps it's not transitory. That's from a contrarian point of view, that's a very interesting point, and it tells me that this whole inflation hysteria will probably level off a bit, but it doesn't necessarily mean that this is over. By no means.
Yeah,
by no means.
Yeah, just because it doesn't go up in a straight line doesn't mean that it's over. Yeah, that's a great point. And before we move on from this chart, I just want to point out, people on the podcast won't be able to see this, but the percentage increase in M2 money supply in 2020, 2021 got up to over 25%. At the highest point, we have two peaks in the 1970s. At neither peak got up above 15%. So we've gone from 15% in two spikes in the 1970s to a spike in 2020-21 of over 25%. That in and of itself is really staggering.
And George, what was the performance of gold last year? In dollar terms, it was up 25%.
Right.
Of course,
Also,
it
that's
might be
interesting, isn't it?
It might be a coincidence, and we can talk about gold later on, obviously. But I thought that's pretty interesting, and therefore I think gold did its job last year, and gold discounted. Actually, it's people should not forget that gold was actually walking from or going higher from 1250 up to 2000, basically in a straight line without any major correction. Now,
Right.
I think the fact that everybody is so frustrated now with gold, yeah, and even the biggest gold bulls that I know, they seem to be close to throwing in the towel. I think that's a pretty good sign, and therefore 25% last year, pretty decent performance, and gold, I think, discounted it sniffed out what's gonna happen very very early on, and I always say, well, don't forget the job of the job of gold is not to make you rich. It's to preserve your purchasing
That's right.
power.
That's right.
If you want to get rich, buy Bitcoin, buy cryptos, buy junior mining stocks, whatever. But don't mix up the volatility and the risk reward ratio of gold compared to those other assets.
Let's talk about miners for a moment, Ronnie. Yeah, gold's been flat or so; it's been down. What have the miners done, and what is their cost basis? I mean, we've had a lot of inflation, so has their costs gone up as far as the cost for them to get that 1 ounce of gold out of the ground? Are their costs higher than the price, lower than the price? How does that work?
Well. Actually, George, I saw, like, I think 170 mining companies this year. So I had one-on-one meetings. Most of them, unfortunately, only virtually, which is a good thing, because mining companies can save on their travel expenses, and
Right.
those numbers were pretty staggering for some companies, especially the smaller ones. But I have to say, out of those meetings, the majority was really, really positive. I think the companies did their homework. If you have a look at balance sheets of the large caps and also the mid caps, really pristine balance sheets, enormous amounts of free cash flow generation. They're raising their dividends. I've got one chart in my slide decks that compares the valuation numbers like price cash flow, price EBITDA, price book, EV, EBITDA, margins, and some other fundamental data from the GDM index, so the mining space, to the S&P 500. And I think the main takeaway is not only relative to its own history, but also relative to the broader market. Mining stocks are dirt cheap at the moment. Of course, we see that costs are up, but I think that especially when it comes to energy, but also to labor, I think that the companies managed it pretty well so far. So we don't see any explosion of costs.
There's CapEx cycle. That's very. In fact, can you unpack that chart? That seems interesting.
Which one? Sorry,
It's
cycle.
the gold and silver miners CapEx cycle.
Yeah. Well, let's basically.
So you've got a yellow line, which are the gold prices, and then the aggregate trailing 12 months CapEx. So this is basically what the price is doing relative to how much they're investing in new
This
supply,
one,
I would
Yeah,
imagine.
yeah, got it, got
Is
it.
that
Well,
correct to assume? Am I right there?
yes. Yeah. So I think that, we shouldn't forget that in mining in general, so not only gold mining, we saw a brutal bear market.
Yeah, right.
And I think, if you talk, for example, to students, I mean, what's like the best industry to go to, and what should you study? I think that mining engineering and geology is probably the last thing that you will
Yeah,
hear. Um,
yeah, and farming.
yeah, and we also know that if you want to become a successful mining engineer and if you want to become a great geologist, I mean, you need many years, if not decades, on the
Right.
field.
Yep.
So we're seeing this lack of talent, but most importantly, we're seeing this lack of capital investments. And I think it's, this whole greenflation that we're seeing. This is a topic, especially over here in Europe, where everything seems to be about sustainability and greenification and whatever. And most people that I discuss those topics about, I think they don't have a clue about energy markets. They don't have a clue about mining in general, and those people criticizing, this dirty mining. I often just ask them, well, did you ever visit a mine? Most
Yeah,
of the
right.
times the reply is no, and I say, well, I visited many mines all over the world, and I can tell you, if you want to have an iPhone, if you want to have a laptop, we will need some mining. And actually, those companies, especially the listed ones, they really focus on their responsibilities. Those companies are mostly doing a really good job. However, I think that everything that has to do with mining and also, of course, natural resources in general with fossil fuels is something bad nowadays.
Yeah, yeah. The politicians don't care about reality; they only care about narrative. That's what
Exactly. It's all about virtue signaling, and
right.
it's therefore I think it's this whole capex cycle will be even more extreme, and we know how long it takes to permit a mine. We know, for example, that's not only in the copper market. We also see it in nickel, for example. We're seeing it in lithium. We're seeing it in many markets where actually we will see enormous supply shortages. Now, normally the market solves that with higher prices. And the cure for high prices is high prices, obviously. But I think this cycle will be even more extended, because as you can see on this chart, we didn't see any major capital investments in the gold industry, but in mining in general. So this also leads me to the conclusion, and I think we should also say that when it comes to commodities, while quantitative easing is basically an asset swap, and we know that it fuels asset price inflation, and it didn't really affect the economy, and it didn't really affect inflation numbers. While if you go into massive fiscal stimulus, and if my thesis is correct that fiscal policy will take over, of course, this will have a much more direct impact on the economy, on inflation, and also on the prices of commodities. I mean, over here in Europe, they want to basically copy what the Chinese are doing. It's going the other way around, because we always blamed the bad Chinese for copying everything.
Sure,
Now we are coming up with a European One Belt One Road initiative, which is, from my point of view, it's a bit naive, to be polite. But those measures that will be taken to improve our infrastructure, of course, they will have an impact on a very tight commodity market.
right.
So I think this will be one of the major drivers going forward.
I didn't know that Europe was talking about that.
Well, they're talking about quite a lot, and I
So
think
they're talking about infrastructure spending to stimulate the economy.
yes. Some sort of a European Silk Road initiative is being planned. It's very early on, but yeah, I think they want to come up with
Yeah,
something.
so it's like a Green New Deal type of thing that we have here in the United States, which to your
Yes.
point, if you look at, even if they spend half that much money on, you will need commodities that far exceed our current supply.
Exactly. And we crunched the numbers in our last study, and we said, okay, what does have the highest inflation beta? So what works in times of rising inflation? And the result is crystal clear. Commodities have got the highest inflation beta, followed by gold. So I think, if you think that inflation will stay around, that inflation will remain a topic, then I think that commodities and gold are a good choice in that environment.
Yeah, great points. I'm looking at a chart right now that says miners are still in anti-bubble mode.
Yeah.
Can you
Well,
explain that?
Well, having a look at the gold box, or not, that's the X EU mining index versus the S&P 500, and I use ratios quite a lot, George, because I
Right.
think nowadays all markets are massively manipulated. So I think relative prices and ratio charts give you much more information than absolute charts. And I think that compared to the S&P, you can just see on this chart, we're actually very, very close to the lows that we've made in the year 2000,
Right.
which was a great time to buy miners. Now we made already lower lows, and we've slightly recovered. But I just like this setup with mining companies doing a good job, focusing on shareholder value, having great balance sheets, and they don't need gold prices to go to 3,000. They At the current price, they make huge amounts of free cash flow, and they are paying out nice dividends. So I think this, in combination with sentiment that is really, really bad, and I saw that at most of the investor conferences. Of course, it was also attendance was also affected by COVID, definitely. But I think from all sectors, I would say that the mining space is probably still the most hated sector of the stock market, and that's what I like, in combination with great fundamentals.
I completely agree. And let's just rewind a little bit and go back to that earlier thought. You're talking about the beta between commodities and the rate of inflation. And you've actually got a chart here that outlines that. And it's what are the best inflation hedges? So commodities, number one, gold, number two, and then REITs, and then 1 to 5 year tips. I know a lot of people talk to me about real estate being a potential inflation hedge. Do you think there's a difference between like just someone going out and buying a rental property in an actual REIT because of the fees or because of some sort of nuance there? Or do you think this is pretty indicative of real estate in general?
Um, I mean, REITs are obviously. I mean, that's a very complex asset class, I would say.
Yeah, right.
And I have to say, I'm by no means a real estate expert. I'm by no means a REITs expert. Therefore, we don't have an opinion on that. To be honest, and at some degree, I had to realize, or I found out that I don't have to communicate an opinion on everything, but there are
Yeah.
just a few parts that I know quite a lot about, and I try to focus on those things. But I think just anecdotal evidence. I mean, real estate prices all over the globe are growing crazy,
Yeah.
and I mean, I don't know. The thing over here in Austria is what I'm experiencing, that for a young family with both parents working, it's basically unaffordable
Right.
to buy even a very modest house.
Yeah. And that's
So
with and
therefore, I
that's
would
with
say
interest rates at almost zero on the
exactly,
mortgage. Yeah.
exactly. So therefore, I mean, would I really speculate with money in real estate at those price levels? I don't know, but as I've said, I'm definitely not an expert on that.
Yeah, but I like commodities. I like gold. That looks great. And then maybe the I just to mention here the 1 to 5 year tips, that's below REITs, and then the 10-year tips, which people think are kind of an inflation hedge, that's even lower than the 1 to 5 year tips. It's even lower than high yield bonds. So let's move down to another chart here that I think will blow people's mind. This is basically the Buffett indicator, if I'm
Yeah.
not mistaken, and that's the U.S. stock market is now twice as big as the U.S. economy. I think just pause and let that sink in for a moment here. And for those on the podcast, we've got the dot-com bubble. It was about 150% of GDP, and the GFC 2008, it was right around 100%. And now it's looks like over 200% the stock
Yep.
market of US GDP. Staggering.
Well, I mean, there's a couple of angles on that. First of all, I mean that already tells you the amount of, I don't know, financialization
Right.
of the US, and how dependent basically the US is on high stock prices. And somebody, I read that piece today, I think by Eric Cinnamont, and he said there were a couple of surveys asking young people basically, why don't you get a job? I mean, there's lots of good jobs out there, and most of them said, well, I don't have to work because my portfolio is doing so great.
Yeah, right.
Why should I work?
In
I
crypto,
mean,
Dogecoin, they've made $1 million on Dogecoin in the last 6 months. Yeah.
but but I think so that's one point, and this already tells you that the Federal Reserve is trapped, because obviously they know that, and they don't want to risk anything. They write extensively about the wealth effect, but then on the other hand, I think it's also a sign of the cracker boom that we currently are in,
Right.
and I don't want to compare it to, I don't know, the stock charts at the stock exchange in Caracas, or in other high inflation or hyperinflation countries. But I think I just want to throw in the thought that perhaps it's also a consequence of inflation, of people losing confidence in paper money, losing confidence in the system. And as you know, I'm not only from Austria, George. I'm also very much adhere to the Austrian School of Economics. So I always have my Mises on my desk. And just a brief quote from Human Action,
Yeah. Yeah.
where Mises writes about the crack up boom. In German, it's called Katastrophenhaus, which is an even better term. He writes, but if once public opinion is convinced that the increase in the quantity of money will continue and never come to an end, and that consequently the prices of all commodities and services will not cease to rise, everybody becomes eager to buy as much as possible and to restrict his cash holding to a minimum size. And then he goes on, the mathematical economists are at a loss to comprehend the causal relation between the increase in the quantity of money and what they call velocity of circulation. So read Mises, read Human Actions. It's all in there. And I think, it's no coincidence that, if we would have a proper monetary system, if we would have sound money, there wouldn't really be a case for Bitcoin. There wouldn't really be a case for gold, probably. I think that in that environment, the stock market would trade at different levels. But I think, you know, those
different. Yeah, that's an understatement, Ronnie.
so those developments that we're all seeing are just a consequence, and people just want to you know, exploit opportunities and find solutions to come to hedge against what's happening and what will be happening. So therefore, I think it's a very, very interesting chart, but it also tells you how trapped the Federal Reserve is, and they, I think, you know, everybody thinks that there will be a rate hike cycle starting in spring. I clearly bet against that. Yeah.
Yeah. I think we might have a rate hike, but as far as a cycle, yeah, I don't think so. Not as with as much as the U.S. economy is financialized. I just don't see that happening.
Yeah.
But
Yeah.
we'll have to wait and see. So the main takeaways here: look at gold, look at miners, look at commodities, and read Mises.
Yeah, that's a pretty good summary.
All right. Ronnie, thanks a lot for another great interview, buddy. For my viewers and listeners who want to find out more about what you do, where can they go, and where can they get this report?
Well, this is the printed copy, 350 pages, but there's also a compact version. Actually, the Chinese version will be published on 15th of December. So if you want to practice your Mandarin, but you can download the compact and the extended version, the XXX version, on our webpage, ingoldwetrust.report. You can download all our presentations, all our information regarding our funds, our services on our webpage, incrementum.li. And I'm also pretty active on Twitter, and my handle is at Ron Stöferle.
All right, buddy. Appreciate your time. Can't wait to do it again, Ronnie.
Absolutely. Many thanks, George. Take care. Merry Christmas, and yeah, be good.
Hi, guys. I'd like to invite each and every one of you to the next Rebel Capitalist Live event. If you are a fan of the Rebel Capitalist show, I guarantee you will love the live event. The next one is Houston, where you can meet and listen to speakers, all your favorites from the Rebel Capitalist show. People such as Dr. Ron Paul, Chris Cole, Lynn Alden, just to name a few. If you want to check out the rest of the speaker list and find out how you can attend, we'll put a link in the description below, or you can just go to rebelcapitalistlive.com. This is an event where you can learn to build wealth and thrive in a world of out-of-control central banks and big governments. But it's not just about building wealth. It's about increasing your freedom and networking with like-minded individuals, fellow rebel capitalists. It's an amazing event. I know you'll absolutely love it. Check out rebelcapitalistlive.com, and I will see you in Houston.